Relief, excitement. How would you describe the market's response to Fed Chair Jerome Powell's speech on Friday? Because you really saw the market start to move after his speech was delivered.
Good morning. So I would characterize it using your word as excitement. And I think the concern was that the tapering process, I think, would begin more aggressively and I think earlier than people had expected. It seems like tapering will, according to his words, happen this year, but this year will likely be probably closer to the end of the year than likely in September. And what we saw against that backdrop is a big move in the cyclical assets. I'm talking energy, materials, industrials, things that do well when the interest rates rise. And that's really what we saw is those stocks do very well. That's different than what we've been seeing now for the better part of the last 3 to 4 months since interest rates, the 10-year yield specifically, peaked in March.
The last time the Fed scaled back on its asset purchase program in 2013, you saw the market decline by around 7%, but then the S&P 500 came right back up. I mean, this is a market that has really rewarded those who buy the pullback. I'm curious your thoughts on how the market sort of tries to respond to a potential tapering in this fall.
Well, I still think we need the pullback to buy. And I think in reality, when you look at rate hike cycles, and I'm talking less about tapering and more about rate hike cycles, stocks tend to do very well heading into the first rate hike. On average, they gain 9.5%. And then even after we go forward for the next 24 to 36 months, stocks continue to grind higher. So what we see is rate hike cycles do not precipitate the end of the bull market. What precipitates the end of the bull market is recessionary factors. And right now, we don't see any of those on the horizon. Corporate profits look quite robust. We have inflation, and I think that's what people are focused on. But in reality, that's very good for corporate profits. And really what this is likely to do is to continue to keep the direction of the market pointed higher.
Digging a little bit deeper, energy was the best performing sector last week. It's been moving for a number of reasons. You could say geopolitics and also this hurricane down in Louisiana. Would you be putting money to work in this sector based on these headlines?
I think energy presents a good opportunity. All of the groups that have economic exposure do very well in this type of backdrop. Energy is a very good example of it. There's a commodity play there as well. And frankly, we think that's still going to continue to support upside for the group. But anything in the cyclical sector, including energy, so materials, industrials, financials, are going to continue to work if we see interest rates continue to rise for energy, if we see oil continue to move higher.
Within industrials, what do you like? Or is it the agriculture equipment players like Caterpillar and Deal or other names?
We prefer the more economically exposed groups. So less aerospace and defense, less business services, more kind of capital goods, ex aerospace and defense. So the names you mentioned certainly could do well in this environment. But anything early, middle stage industrial should work very well here.
And speaking of industrials, we have manufacturing, factory orders coming out tomorrow, and then the jobs report on Friday. What will you be looking for, Patrick?
Ultimately, we want to continue to see the pace of job gains continue to be very strong. I think the concern is that as people head back to school, that the job gains won't come through, and that's a concern around Delta. Ultimately, we want to see continued strength in the labor market, and we expect to see that.